Level 5, Chapter 2. Derivatives. Derivative financial instruments, most commonly called derivatives, are complex financial instruments traded for risk management and speculation purposes. The price of a derivative is based on, or is derived by, the price of another financial instrument called underlying instrument, or just underlying. Derivative represent contracts between two parties for transaction of an asset upon certain circumstances. Derivatives have notional value, meaning that a very small amount of invested money can control a much larger sum of money. This makes derivatives attractive, but also very dangerous for trading. Futures. Futures contracts, or just futures, are a derivative whereby the two parties agree to transact an underlying asset at a future point in time and at a predefined settlement price. A futures fixes the price of an asset for both parties and leaves them from the risk that the price will fluctuate. There is always a side that wins and a side that loses money in a futures contract, yet both parties benefit in that they mitigate the risk of their portfolios. Futures are standardized in terms of size and maturity dates. The parties that entered in a futures contracts adjust their cash position every day according to the value of the underlying, a process called mark-to-market. 97% of all futures are speculated. They are closed before delivery of the underlying instrument takes place. Options. An option is a contract between two parties which grants the buyer of the option the right to buy or sell an underlying asset or instrument at a specified price on or before a specified date. Expiration date. Notice that the option buyer has the right but not the obligation to exercise his option at any time before expiry. In contrast, the seller of an option has the obligation to transact the asset to the buyer of the option if the specified price, called the strike price, has been reached and the owner wishes to exercise the option. Options work much like insurance policies. The buyer pays the option seller a premium for having this right to buy or to sell the underlying instruments. In contrast to insurance policies, options can be freely traded on organized exchanges. Like futures, options can be on any kind of instrument, such as stocks, gold, FX, etc. An option that gives the buyer the right to buy a certain asset at a predefined price is called a call option. An option that gives the buyer the right to sell a certain asset at a predefined price is called a put option. Thus, we arrive at 4 scenarios you can be in if you trade options. Long call. You bought a call option. Short call. You sold a call option. Long put. You bought a put option. Short put. You sold a put option. Long call. When you have bought any option, this means you have already paid a certain premium that has guaranteed that you are immune from unfavorable price movements. However, the premium you have already paid for the option represents a cost for you. Unless the option goes above the strike price plus the premium, as shown in the payoff diagram above, you will be at a loss. Consider buying a call option. Costs $2. Strike price equals $4. Current market price of stock equals $8. If you have bought a call option for $2, that gives you the right to purchase stock ABC at $4. And if the price of stock ABC is $8 now, you can exercise your option, buy at $4, and then sell on the market for $8. You have revenue of $4 from this transaction, and when you subtract the cost of the premium, the $2, you profit $2. Profit as a percentage of initial investment equals 100%. The short call is a mirror image of the long call. Long put. Buying a put option gives you protection if you wish to avoid the consequences of the market going down. A put option gives you the right to sell your underlying instrument at a specified price. If this price is higher than the market price, plus the cost of the option, you profit. If not, your loss is only limited to the money you paid for the option premium. Consider buying a put option. If you have purchased a sell option for $2, that gives you the right to sell stock ABC at $17. And if the market price of stock ABC is $10 now, you can exercise your option. Sell the stock at $17 and then buy on the market for $10. You get revenue of $7. And when you subtract the cost of the premium, the $5, your profit is $2. Profit as a percentage of initial investment equals 40%. The short put is a mirror image of the long put. Option trading strategies. Naked call, naked put. As you saw in the examples on the last two slides, your percentage returns was as high as 100% and 40%. A high return means high risk. Therefore, in order to avoid such risk, you have to take opposite positions on the underlying and the option. Remember, naked positions can make you go bankrupt in a minute. For example, if you buy one stock, you have to sell options on the stock in order to minimize the risk. Professional strategies. Besides the naked strategy, classical trading option strategies which involve the buying and selling of several options include straddle, strangle, butterfly. Other types of derivatives. Apart from futures and options, there are other various types of derivatives that are popular among traders. These include swaps, CDO, collateralized debt obligation, CDS, credit default swaps, caps and floors. For more information on these, please check our manuals. In any case, no matter the type of derivative, trading derivatives is only for experienced traders, not for beginners.